But Amin says, say a couple of months ago, I sold a 52 strike covered call expiring in January of 2025 when the stock was trading at $42. So we bought a stock at 42, sold 10 points out of the money, 52 call for $8 per share. Today, the price of that option is $7.85 a share, and the price of that stock is 46. What is the best way to maximize the profit on the position? Okay. Do I have anything here? Well, there it is. I'm going to use FTAI Aviation. I don't think they have 2025 options, though. Let's just go ahead and check that. Oh, they do. Fantastic. Okay, now I don't think this is the stock. He just gave me a stock that was trading at $46. I'm sorry, my apologies. $42 a couple of months ago. And now it's trading at 46. And we had sold the January 2025 52 strike. Is there a 52? Let's hope there was a 52. It might only be 45, 50. It's only 45 and 50. That's okay. I mean, we'll use the 50 as an example in this case. So, as we did for David, let's go into the portfolio and let's enter our position. Our stock is FTAI. I don't know if the price was at 42 a couple months ago. Could have been. Doesn't matter. I don't even think this is a mean stock, but we know it's trading right at 46, so that satisfies where we are today. So we bought FTAI, let's say, 100 shares. And this a couple months ago, so let's go Happy Halloween. Let's go October 31st, and we paid $42. Now, at the same time, we sold a January 25. I don't have a 52 strike on this. We're going to use the 50. Mathematics are going to be the same, although the percent return, if assigned, is going to be different. So we're selling a 50 strike call. Well, this isn't worth $7.85. You sold it for $8. It only dropped 15 cents. All right, so let's call it 8.00. Oh, and also 1031. All right. So here's our covered call position. We have a 9.5% gain in the underlying security. And ignore this because we only made 15 cents on it. So the original expected return was 47%, 300, and actually it would have been about 435 days away if we opened this 2 months ago, adding an additional 60 days to the remaining time on the option. And right now we're at a return of 19.3%. It's actually lower in Amin's example because he's only gained 15 cents on the option premium, not on the 52 call that he sold. I know it's the 50 call. He sold the 52, went from $8 to $7.85. The profit here is in this position. Okay? When you're selling a far out in time covered call, such as this, I'm going to do it. Let me go to the call research. No, I'm going to go to the option chain very quickly. We're going to go January 2025. And I'm going to go to calculators. And I want to go to Black-Scholes. So when you sold this call, you've got a very high downside protection. You had a high potential return if assigned at 300 or 430 days if the stock was trading above 52 at or near 2025 expiration. But as you'd expect, one of the reasons why in the reverse, when we use the married put position, buying stock and buying a put option to protect the downside, I mentioned that for a specific reason we'll see in a moment. But we buy the option at least 180, 200, maybe even 365 days out in time, instead of buying a cheap put month by month by month. Why? It's because one of those basic rules of options is that when you sell premium, typically you want to be selling month by month or week by week, somewhere in that time frame, because you're going to get a higher annualized return selling the option month by month or week by week. When we're buying, we want to buy further out in time because the option that's 1 year or 2 years out in time is not 2 times or 3 times the cost of the current month option. It's not linear. The option that's 6 months out in time is not 6 times the cost of the near term. The option that's 1 year out in time is not 12 times the cost. It's just like insurance. If you go to pay home insurance and you say, hey, I want the annual rate, or for your car insurance, I want the annual rate, you get a discount. The same things are true with options. If you're selling something further out in time, it's not 12 times the cost of the near term month if you're selling 1 year out. So you get a better annualized return selling month by month or week by week shorter term, and you get a lower annualized cost buying further out in time. And the benefit of the married put protection further out in time is also the time decay is very slow until you get into that last 90 to 60 days out in time. That's when the time decay really starts to kick in. But we're in a covered call. So we're not expecting to see much of the time value decay. As you saw, your stock moved up. It was closer to at the money now, sort of following the ATM Bell Curve. So we went from our 52 strike here. Stock was at 42. Now it's at 46. So we saw some swelling at the money Bell Curve. And you've only lost or gained 15 cents on the premium. You haven't really seen any time decay, sort of due to this swelling of the at the money Bell Curve, and also maybe some shifts in volatility. Now, this is important because you're in a covered call trade right now. You don't have a lot of gain on the call. So there's not much you can do with the call to buy it back, roll it to the 50 strike, buy your 52 back, roll it down to the 50 strike to get more premium. You could do that, but is that locking in any profit? Not really. And unless you get $2 more than your buyback cost, because you haven't really made anything on this call yet, and we're not expecting to until we get further down the road, maybe 6 months from now, 7 months from now, somewhere in that time frame, where we start to see more time decay or the stock drops, which we don't want to see. So we can look at rollout opportunities for this position. And go to position actions, as I mentioned, Amin. We'll go to position analysis. And we know right now that your maximum target return, if everything works out the way you want in 2 years, is 47%, 47.1%, meaning you stay in this position, the stock at 2025, roughly 348 or 370 days, about 430 days from where you began. In 2025 is trading above your strike price at 52. My apologies, 52. Your return's actually higher because you have the 52 strike. So this might be up as high as 50 or 51%. Okay, but current liquidation, you don't have that because you haven't locked in that $2 we're seeing in our FTAI example. You've only locked in $15. So you have some gain in the stock of $4. You're really only looking at a profit of about 415 on this position compared to, that return up here. So you're probably at about a 9 or 10% return, maybe. No, maybe like a 12% return. All right, now, the problem with rolling an option that's 2 years out in time is there's nowhere else to really go to roll for a credit. You can't go further out than 2025 right now, can you? You push the limit of the expiration dates. Now, like I said, you could buy to close yours for a shorter premium right now, only $7.85. It's essentially washed, and collect more premium by selling a lower strike. In your example, you might be moving down from the 52 to the 50, but your overall return might not be as high because you don't have the 52 strike anymore. You only have the 50. You're giving up $2 of potential upside, but you are generating more premium. But your first option is a wash. You collected $8 for it. It's at $7.85. You need more time decay on that position. You need more decrease in premium in that position to lock in or maximize profit on the position. Alternatives. Well, one thing that I might consider doing, let's just go to the profit and loss chart for our position. You have an unrealized $4 gain in the stock. You received $8 in premium for selling the 50 strike call. If I went out to January 2025, that's not going to cut it. Well, maybe I can take half of that and buy a 45 strike put, which is $3 above your cost basis. I'm going to pay about $5.20 for this, but remember we initially took in 8, but I'm going to a higher strike than I purchased. So what do we have here? The potential return of 47.1%. Yours again a little higher because you actually have the 52. But let's go ahead with that 45 put that's right at the money or slightly out of the money. And now what do you have? You have a position that's locked in most of the unrealized profit on the trade, but you're giving up some of the potential upside. Now you can always roll this call later once you get the time premium. How to maximize profit on the position when you had this move. It's hard to manipulate the call that you have for January 2025 because it's only dropped from $8 to $7.85. There's not much wiggle room. You could roll it down to the 50 to get more premium, but unless you're getting a full $2 more than your buyback cost of $7.85 for that lower strike, you're also going to lower your maximum potential return because you're going to be assigned for $2 less than you initially anticipated. So what I mean is if I bought the call back, so we sold the call for 8, I buy it back for $7.85, unless I'm getting at least $10 for the 50 strike by rolling down, I'm not really helping myself increase the potential profit because I need to receive at least a $2 credit for the buyback cost of $7.85. And yes, $10 is $2.15 higher, but I'm dropping my max potential return from 52 down to 50. In order to just adjust the call to maximize profit on your position, Amin, you need to see more time value decay. To lock in unrealized profit that you had from 42 to 46, this potential, and I know this isn't your stock, but the potential of maybe buying a 45 strike put, or if it's there, a 43 strike put anywhere, or 44, anywhere above your purchase price of 42 for a cheaper price than less than you originally received from the call, you might get yourself into a no risk position where the worst case scenario is a guaranteed profit of 10, 12, 15%. And the best case scenario is still 27%, which I understand is maybe about half of what you originally anticipated with the max return. But if you're planning on looking to adjust this position, you've already paid for this put that's still 380, 370 days out in time. You have a no risk position right now as it stands for at least that next 378 days. You paid for it with the call already because you have a cheaper price. Now you can still choose to roll this call up or down as needs be, or if you see the opportunity to maybe have a further locked in profit or a higher bulletproof status and start working this return back up as well. You have a $4 unrealized gain in the stock, but you've only lost 15 cents on the call. In order to try to maximize profit, just manipulating the call and staying in a covered call position, Amin, you're going to need to see more time value decay. It's as simple as that. In order to buy it back or move it closer in, to try to maximize your annualized profit shorter term, your trade is a wash right now. The call value that you have is a wash. And again, one of the reasons why is that thing we talk about related to the put strike selection and the married put, or really any options position, is the at the money bell curve. You look at any options chain at any expiration, and the option that's right at the money, in our case, the 45 or 46 strike, whether it's a call or the put for any expiration, that's going to have your highest time value. The options that are out of the money have a lower time premium. The options that are in the money have a higher total premium, but most of it's intrinsic, not all of it's time. Now, in relation to what you're seeing with your option, with the possibility also of different volatility flux over time, you sold the 52 strike. When you sold the 52 strike, the stock was at 42. So you're 10 points out of the money naturally. Now the stock has moved up and is trading at 46. So this extrinsic value, the time value or extrinsic value, has actually increased slightly because the intrinsic value went down by 4 points, but your option just changed from $8 to $7.85. So even though you'd expect that, hey, my stock went up 4 points, I'm only $6 in the money now instead of $10 in the money. Shouldn't my option just be worth maybe $6 or so? Or, $7, because there's still a lot of time, 370 days. Let's say $7.50. And that's about right, by the way, the $7.85, $7.50, that's about right. But again, you're seeing that because of the swell in the ATM bell curve. Time is working with you, but it's working much more slowly. You're over here. You started off in that 430, and now you're at 378. This inflection point here starts maybe at about 90 days. This downward slope starts at 60, and the final decay really kicks in 30. And if I draw this out a little bit further, and 15. That's when you really start to see the time decay. But we're still up here for a while. I'm not expecting to see a lot of this extrinsic value, this out of the money value, continue to decline in price until we get closer to this time frame. And you're going to need that to manipulate the call, to take the profit off the call, to try to manipulate the call, if you just want to stay in a covered call position, to take advantage of this $4 profit. The way to lock in the profit of the $4 you're missing is take a look at some of the put options that are available, that are at a price, same expiration typically, but are at a price that's lower than what you initially received. You could end up with a complete no-risk trade on this position for 378 days and continue to work the trade as time does decay in your favor. Of course, to get that return back up to maybe closer to where you wanted it to be while keeping a no-risk position, even if the stock collapses down to $30, $28, $25 per share. So you can see the rollout opportunities in the portfolios we mentioned, Amin. You can do what-if scenarios here by evaluating which puts to buy. You could also use the insurance tool under the married put. This doesn't take into account that you've already sold the call, though. But I could go in and I could say, with the insurance tool here for the married put, I can put an FTAI. I can put in my cost-based share of 42. And I can select the different expirations. Let's go out to January 2025. Oh, there we go. Okay. Sorry, I do apologize. I just saw there that some of the 2026s are available. It is possible that your security, you didn't give me a security name. We're using FTAI as an example again because the stock's at 46 where you said yours was, Amin. But you might have, I forgot about that. The 2026s did start coming out in September, I believe, maybe October. And so they're slowly starting to, well, they're quite rapidly, but they're drifting out. That was my mistake. So you might have a 2026 available, just this particular stock did not. It ends in 2025. All right, so we have an unrealized profit of 9.5% in the stock. With the stock trading at 42, we see here we can buy that 50 put or that 45 put here at a better price, it looks like, because it's not at midpoint, but this 515, that's not a guaranteed profit. I'm sorry. That's still a risk of 4.6%. I could buy the 60 put, but I think that's too deep in the money, but that would bulletproof the trade. But remember, you have stock at 42. You collected $8 against it, so your cost basis is essentially 34 until you make any adjustments on that call. And so there's that 45 put we saw. Buying that now at 515, a locked-in profit of 14.9%. The 50 put would give us a locked-in profit of 16.6% of technically the 35.3% unrealized gain we have if we account for the full $8 in call premium against our cost basis of 42, which I don't yet, honestly, because you won't realize that till expiration. And if you close the position anytime early, close your call, I should say, anytime early, it's still going to cost you $7.50, $7.80. So you didn't realize the full $8 yet. You need more time decay to work manipulation of just the covered call position to try to maximize the profit, or evaluate taking some of your premium off the table by purchasing a put, which, as we showed, would lock in those gains. And those concepts, of course, are discussed, real quick plug, are discussed in the blueprint. And of course, the blueprint is the full course on our preferred married put structure, buying the stock, buying the put 6 to 8 months out in time, maybe even a year out in time, to control risks guaranteed to single digits, and then use 12 different income methods for the next 4 or 5 months or so against that to lower that initial low risk, bulletproof the trade, increase profits, and lower the cost basis. And of course, we always run the end of year promotion for the blueprint, and we've extended that into January. So if you purchase the blueprint before mid-January, you're going to take advantage of these 8 bonuses here. You get 2 discounted months of our Fusion subscription at Radioactive Trading, where you can follow along with Ernie and my trades, various lessons there, and members-only content. You get that for only $10 per month for the first 2 months. It's usually $69. We're going to send you one of our Mastery Series videos, Foundations of Radioactive Trading, additional bonus video. You'll have immediate access to the Quick Start Guide. You'll also receive 1 month of Power Options, but the discounted months of Fusion and the free month of Power Options, you can start at any time. You don't have to start right away. You can start those at any time. It's all electronics. You get instant access to the blueprint when you make your purchase of $349. You always have access to myself and Ernie via email, via phone, coaching sessions, and things of that nature. And of course, you also have members-only content as a blueprint owner, and later on, additional members-only content as a Fusion subscriber as well. So again, that's going to be still available. It is extended. The cost of the blueprint is $349. When you go to the products page here at Power Options or Radioactive Trading for the blueprint, if you do some quick math here, you'll see that the value of the bonuses that we're giving is higher, essentially, than the cost of the blueprint itself.